Hi everyone, I'm Paul and welcome to my review of Lesson 24 of ICT's 2022 Mentorship Program. Today's video is going to be a little bit more theory based, but I'd argue it's going to be one of the most important. So if you've still been struggling with some of ICT's concepts and it's just not really clicking for you yet, then I think today's video is going to be just what the doctor ordered. But before we jump into today's video, if you enjoyed this video, it would be great if you could give it a like because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy, and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then check out the link in the description and subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's video is lesson 24 of ICT's 2022 YouTube Mentorship Program. And we'll just run through a brief outline of what we're going to cover in today's video. So the first section of the video, we're going to cover the unanswered question we had from lesson 23's review. So if you've already watched that video, you'll know that we covered some of the comments from ICT's community page, and there was a specific unanswered question that we had from that, and so we review that in today's video. The next section, which is the theory section of this video we're going to cover, is ICT's 2022 mentorship model entries. And I think this is probably one of the most important topics that we've covered in the mentorship program so far. So just for context, we're actually looking at the NASDAQ and we're looking at the 5th of May. So this was just after the FOMC meeting. And if you recall from lesson 23, we had this area here, which was that FOMC news event. So we had the volatility here. The market raced higher after sort of whipsawing in each direction. And then we created these relative equal highs just here. And just as a refresher, what we were talking about in lesson 23 was this particular message from ICT's community page. So post FOMC, basically ICT goes, open your 15-minute ES and NQ charts, drop a horizontal line across those smooth criminal highs in both index, see how we dropped into a discount overnight, study how they treat those relative equal highs today and NFP Friday. So this is the particular thing that we're looking at here, is these relative equal highs on both the NASDAQ and the S&P. And so we'll just jump back to the chart and we'll just run through that now. And so this is that zone that ICT was talking about, these relative equal highs just here. So after that announcement, you can see we painted those here. Now, if we actually zoom out and we go to say a 1 hour chart, you can see that we can actually extend these relative equal highs all the way across. And you can see we actually tag these highs here. So this is even more powerful because the more highs that we have, these relative equal highs at this level, it means the more liquidity is residing above these levels. So that makes it even more important. So this is why ICT was highlighting this particular zone. Now what he was actually talking about, and this lends to the discussion we're going to have next about entries and about why this is important. And this is also why he went on a little bit of a rant, if you want to call it that, about people who were actually using this as a mechanism for entry. So the people who took these trades based on what he was talking about. And really it goes without saying, if you're following anyone on social media, you really shouldn't be taking trades based on what they're showing you. This is really just for education purposes only. And long term, you're really just cheating yourself because you're not learning anything if you just copy someone. You need to understand the mechanisms behind their doing what they're doing so that you can then go and replicate those yourself, test them, make sure you understand them and that they work for you before you start putting them into practice. So, I agree with everything ICT, said in that particular part of the video, and obviously goes to anything that I cover in my videos as well. This is really just something to help you with your learning, and you should really be going out and practicing it yourself before you put any real money behind it. So with that said, what ICT was looking at was this bullish fair value gap we have just here. So if we extend that across, you can see as we come into what would have been the beginning of the New York session, so here around 9 o'clock, you can just see on this candle here, we'll just zoom in a bit closer. You can see the market starts to drop and it comes into this zone. And so this is, very classic for what we'd be looking for. We've taken out this sell side liquidity here. We've dropped into that fair value gap. And what he was anticipating is that we would get a reaction from this level. The market would reverse and it would race up and take out these relative equal highs up here. Just given there was so much liquidity here, we'd go from the buy side liquidity down to sell side liquidity and back up to buy side liquidity again. So that's what ICT was anticipating, and that didn't happen. Now, obviously, if you're following the mentorship model, then you would know that this basically didn't pose itself as a reversal. So this just became a continuation, and obviously we took out this sell side liquidity down here. We just ran all the way down, and then we just consolidated into the Friday when we had the non-farm payrolls. So as I said, that dovetails quite nicely into what we're going to talk about next, which is the theory about how to apply the mentorship model and how to, contextualize the entries. So in this next section of the video, we're going to go through the theory behind the entries for the mentorship model. We're going to cover both long and short entries, and we're going to cover, the two basic mechanisms of entry that we're looking at. So they're quite similar, the concept's the same, but the situation is just slightly different. So we'll go over those right now. So the first one we'll look at is long entries, and this one will be quite familiar because we're just talking about when we have the market trade down, and it trades down and it takes out the sell side liquidity. So as you can see, we have the market trade down, and this is obviously in place of candles. We're just using a straight line diagram in this case. So you can see the market comes down, we sweep the liquidity, so we don't go through it, we actually touch that liquidity, we reach into that liquidity pool, and the market instantly reacts by trading higher, and then we start going in the opposite direction. So there's a couple of things that are quite important to take from this diagram, and I think once you see it in this format, it's going to help you, if you're looking at on your charts, to not only see the pattern, but to then recognize that this is the more high probability setup. And if you've been having any problems putting everything together, this should wrap up a whole bunch of the concepts around break-in market structure, fair value gaps, and liquidity and so on, and put them all together so that it makes more sense. So hopefully this is the video that you've been looking for, and this will help you to start taking these from concepts to reality in terms of your trading. So we'll just run through it all again. So we have the market trade down, and we go into that sell side liquidity. So we start entering into this liquidity pool. So this is where smart money is going to be buying. So remember, in other videos I've talked about one of the concepts that helps me a lot is to think about where smart money would be buying and where they would be selling. And so we obviously want to sort of follow what they're doing. So we have the market go into this liquidity pool. Now, one of the things that's quite important about this is we have this particular swing high here prior to the liquidity being taken. So this is a really important concept. And one of the things that I've seen in my own personal, trading and in my own back testing is that when you have this swing high here prior to the liquidity grab, that seems to be a higher probability setup as opposed to having the swing high after the liquidity grab. So this is quite important. So the market trades into that. Now we get the reaction from that liquidity pool, and we get this energetic move higher. So this is the displacement that we often talk about in the video. So we get this move higher, this displacement higher, and importantly what happens is this high now basically displaces, so it goes higher than this swing high we have here, and that gives us our break in market structure. So this is important. We have our displacement higher, we break market structure, and in the process of that, we get our fair value gap formed here. So in this case, it's a bullish fair value gap because we're obviously looking to go long. And so that's our, 3 candle formation. I'll draw this really badly just here. So it's going to look, something like this. And that's going to be in this zone here. And this is obviously our fair value gap here. And we would be looking to enter long at the low of that third candle. And then we would have our stop down here at the high of that first candle, or wherever the swing high is down here, whatever makes the most sense. And then what we're looking for is for the market to trade back into this level here or into this area here. So the market's going to trade back up into that fair value gap before trading higher. So this is really the whole entry mechanism in a nutshell. And you can see how we then interweave, if you like, all these different concepts, break in market structure, displacement, fair value gaps, all into this, whole thing, and this is how it all comes together to give us our entry. So if we move on to now our second entry mechanism for a long entry is when we're using the bullish fair value gap as our liquidity pool. So it's exactly the same as what we're looking at with the sell side liquidity. We're just now looking at having a bullish fair value gap as that liquidity pool rather than the sell side liquidity. So one of the things that's I think easy to think about is if we just have the upper band of that bullish fair value gap, if you treat it exactly the same as you would the sell side liquidity, then it makes this whole thing exactly the same. So we have the market doing the same thing. We're trading lower. We paint this short-term high just here before we go into the liquidity. So until we go into this bullish fair value gap. So remember, this is where smart money is going to be buying down here. We instantly get a reaction to the market going into that liquidity pool. We get our displacement, we get that energetic move higher, which breaks market structure. So this high eclipses this high, and this means we get our break in market structure here. And then we have our bullish fair value gap being formed in this area here. So in that displacement is where we're going to find that bullish fair value gap, and the market then trades back down into that level before reacting again and continuing higher. So you can see this is exactly the same as what we're looking at in the first scenario where the market's going into the sell side liquidity. The only difference is the liquidity pool is found inside that bullish fair value gap rather than below the sell side liquidity, but we get exactly the same formation and we get exactly the same reaction. So we're going to look at our short entries now. And this is exactly the same as what we're looking at for our long entries. It's just the opposite. So in this example, we have the market trading higher. We paint a short-term low just here prior to taking out the buy-side liquidity. So the market then trades into this buy-side liquidity pool. And remember, this is where smart money is going to be selling. The market reacts to trading into that liquidity pool and trades lower. We then go lower than the swing low here. So this low is lower, which breaks market structure. And in this move downwards, this should be displacement. It's an energetic move that's going to take out this particular low. This is where our bearish fair value gap is formed. And so that's, remember, our 3 candle formation. So again, this is going to look pretty average because I'm drawing it very rough, but you get the idea. Is we have our 3 candle formation, and our bearish fair value gap forms between the low of the first candle and the high of the third candle. And if we're entering, we'd be going short at the high of that third candle, and we'd have our stop up here at the high of the first candle. So that's going to reside in this zone somewhere here. We then get the market trade back up into that zone. So it's going to trade back up into this area here, react to that liquidity pool, and then trade lower. And so that's exactly what we're showing in this diagram here. So we trade up into the buy side liquidity. We have that swing low prior to the liquidity grab. We get our displacement, our energetic move lower, which breaks market structure, creates our fair value gap. The market trades back up into that bearish fair value gap, and then we start trading lower. So this is a reversal. And so our second scenario for our short entry, very similar to our buy entries, is that we have a bearish fair value gap residing above, which is where our liquidity is residing. So we have the market trade higher. We paint a short-term low before the market trades up into that bearish fair value gap. So very similar to what we were talking about with the buy entry, is if this concept is a little bit difficult for you to grasp, we're trading into a bearish fair value gap, then we trade back up into a bearish fair value gap, is if you just treat the downside boundary of the bearish fair value gap as your buy side liquidity, it's exactly the same as that first scenario. So the market trades back up into this zone. We tap into this liquidity source just here. In this case, it's our bearish fair value gap. This is where smart money is going to be selling. The market reacts to that. We get our displacement lower. We get an energetic move, which breaks market structure. So this low here, the short-term low, is breached by this low here. We then trade back up into our bearish fair value gap. So it's in this zone here where we're going to have our 3 candle formation. We'll trade back up into that zone before then trading lower. So we have our reversal and then we trade to the downside. So I hope that's really helped you to consolidate a number of these concepts that ICT's been teaching in the mentorship program. I think when you look at it sometimes in a different way like this, and looking at these sort of line diagrams and seeing the impulses like this, I found it helped me quite a lot. And it really just helped to bring all those concepts together and just sort of make them all make sense in, effectively what is just a really neat system. So I hope this helped you as much as it helped me. If it did, let me know in the comments. I'd be really interested to hear if this was that sort of one final push that you needed to make everything click for you. I know that it was a really big help for me. Thanks for watching my review of lesson 24 of ICT's 2022 mentorship program. I hope you found today's video helpful, and I hope that it helped to consolidate, a number of these concepts that we've been covering in ICT's mentorship program and, bring them all together wrapped around this concept of the entry mechanism. If you did enjoy the video, it would be great if you could like it because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. And as I mentioned earlier in the video, if you'd like to hear more from me and if you'd like to join a community of like-minded traders, then make sure you check out that link in the description, subscribe to my free weekly newsletter and join our Discord. Thanks for watching, and I hope to see you next time.